Hello again, everyone. Welcome back. In this technical analysis of the stock market video, I title it Severely Overbought because that's where we're at with the market. Of course, you can always get even more overbought, but we are severely overbought as of the close on Friday. So we're going to take a look, start off here with the side-by-side view of the Dow, the S&P, and the Nasdaq. We're going to start looking at the monthly view because we just finished the month of July. And what a month that it was. The bulls are happy, the bears are not. And, the bears basically taking a nap right now. The focus this week is going to be on the S&P 500. We'll take a look at the SPX and the SPY. And then we'll look at the McClellan Oscillator, which is clearly going to show that we are severely overbought. We'll take a look at that 10-year yield, the dollar index, gold, and silver. Okay, so starting off here, when we look at the monthly view, the Dow was up 2,070 points this week. So we don't have a bullish engulfing type candle, but it definitely is, pretty strong type move and got very close to, engulfing the previous month. But again, with these kind of bars, this kind of situation, you need to follow through. And a little bit stronger picture, but very similar with the S&P 500. Now, the Nasdaq was a little more what I would call a bearish engulfing because it opened below where it closed the previous month and it closed above where it opened. Okay, so the body of the candle for the month of July completely engulfed the body of the candle for the month of June. Now, again, even though you have that kind of bullish look to it, you need follow through to continue to push to the upside. Let's take a quick look at the weekly charts. Okay, here's the weekly view. We have the Dow up 946, the S&P 500 up 168, and the Nasdaq Composite up 556. So again, the push, we had the second week of July, a little bit down here on the Nasdaq, same thing on the S&P. They all were a little bit down that second week, but overall 3 out of 4 weeks up, and it made a very, very strong month. So, when you look at this, let's just take a look at the S&P. When you look at this, it looks very similar to the kind of move that we had in March. But when we drill down and take a look at the Elliott wave picture, I'm getting a different look, different feel to it. Let's go and look at the S&P. Now, here's the weekly, here's the daily view. Let's just go right in and take a look at the Elliott wave picture. Now, here's what I'm talking about. Let's just look at the weekly view. Let me kind of draw out the picture a little bit. Clearly, we had a strong move in March, and we're getting a strong move now. But between March and July, we had this move that occurred in May, and we're labeling it as a wave 4. And I know I briefly talked about this in the July 9th or 10th, I can't remember the exact date, video where I said, okay, the alternate view to a leading diagonal pattern on the S&P 500 coming down, and that is now moved to be the preferred count. This is what I am working with, leading on. We've just had too strong a move in here. Nice, beautiful 5-wave move to finish off this 5th wave. And so this is what we're looking at. Now, here's the thing. When you look at a leading diagonal pattern, a leading diagonal in the wave 1 position, when you're in a bear mode, many, many times, you're going to get a very deep retracement for wave 2. So that's what I'm kind of watching for in here. Now we're back up on the pullback, the retracement. We're right up into this cluster of closes in here. So this could provide some resistance, although I'll tell you on the Nasdaq, it didn't provide any resistance. The Nasdaq just blew right through this cluster. So it could very well keep pushing. Right now, I'm counting this as an A, B, C. But again, when you get into corrective patterns, they can morph into a wide variety of looks. I mean, it's just, you start off looking, especially in a wave 2, you start off looking for a zigzag type pattern, and that's what I've got labeled. We'll see if it continues to play out that way. Okay, so that is the picture there. Let's just roll over and take a look at the SPY. So here's what I've got on the SPY. So it's the same thing, got the same count down as a leading diagonal pattern, intermediate wave 1, and we're working intermediate wave 2. So here's this resistance right here, 413.06, 413.06. Now, how did I come up with that? I took the average of these 8 closes right here, and they averaged out to be exactly 413.06. And what was the high on Friday? 413.03. Pretty interesting. Now, we'll see whether or not it's going to hold. Based on the wave count, what I'm expecting to do, I just don't think it's going to, because in an ABC pattern, a C wave needs to be a 5-wave pattern, either an impulse or an ending diagonal pattern. We'll see what we got right now. It's looking and acting like an impulse, but could morph into something else. We'll see. But that's what we've got right now. So what am I doing with this up here? I'm trying to get a feel for, knowing, number one, knowing we could get a deep retracement. Here's 50 to 61.8%. And I'm talking about what? 2 versus 1, okay, as a percentage of the retracement. But then I'm also looking at the time frame. 24 weeks is how long intermediate wave 1 was, 24 weeks. So I'm looking at this and I said, well, let's look at the time for a Fibonacci relationship between wave 2 and wave 1. And so when you start the analysis from the low here on June 17th, here's what you come up with. Now, the first major Fibonacci relationship's 38.2. When is that? August 20th. The next one I would be targeting is where wave 2 is taking 50% as long as wave 1. Okay, and when is that? That's September 8th. So if I had to sit back and say, well, what is my time frame zone? Right now, I would say this is my ideal time frame. Could it stretch longer? Yeah. Could it stretch out here to the end of September? Yes. But right now, here's a couple of targets, and then I'm looking at the deep retracements also. And then, we blow through this area here. Well, where's the next resistance? It's going to be right up here at these highs right here, 429.64 to 429.66, right there. Okay, so we'll be watching to see how does the wave count evolve as we get up into this area. But yes, we're expecting more of a pullback based on what the market's been doing so far. Okay, so that is the SPY. Let's take a look at the McClellan Oscillator. Okay, so the McClellan Oscillator is sitting up here at, let me see if it'll talk to me. Hopefully it will. It's not cooperating. Okay, now I think I got it working here. 288 plus 288 on the Friday's close, okay? Now, the interesting thing about this, yes, we are severely overbought when you get greater than a plus 150. So where the market is right now is more overbought than it was at the end of that strong move in March, so mid to late March right here. But then here's May 27th at 349. So it's just kind of weird on the readings because, the March move right here was a much bigger move than anything we got in May. But yet the May reading right here for May 27th was more overbought than what occurred in March. And now we're sitting here more overbought with Friday's close than we were back up here, but not quite as much as we got here on May 27th. So I guess the message is it's overbought, and so am I sitting here going to sit back and say, okay, time to buy puts? I think it's gone far enough. It's going to go down. No. You've got to wait and let the price action tell you that it's rolling over, and it sure hasn't been acting that way lately. Okay, so that is the picture right now. The market is severely overbought based on what I'm seeing here with the McClellan Oscillator. And this is based on a lot of calculations with the breadth of the market. Okay, let's take a look at interest rates. Okay, here's TNX, and this is the 10-year yield. So it closed at 2.64%, down 14 basis points for this last week. This is a weekly view. Now, this is like a 20-year trend line that I've got on here. And yeah, we were bouncing above that 20-year trend line, but now we've come back down below it, and we seem to be staying down below it. But I think the interesting thing, let's look at, here's the daily view. When you look, it clearly looks like it's rolling over. But I remember when we were like right here, there was a lot of folks talking about and thinking, oh, well, wow, don't we have like a head and shoulders pattern? Isn't this a shoulder and a head and a shoulder? And I remember thinking to myself, what are they looking at? That's not a head and shoulders pattern. I mean, it's not even close. But what we have right now is, now we've got a head and shoulders pattern. And yes, we have broken down below that neckline. Where would I project that this is going to go to? Down to 21.66 or 2.16 on the 10-year yield. So it's going to be real interesting to see, do we continue to come down and head to 2.16? That's what's going to be on my radar as we watch this come on down here. All right, so that's where we're at with the 10-year yield. Also, I wanted to just mention, since we're talking about interest rates and the Fed, of course, just had their announcement. This was a very interesting quote, because I got to say, when I was listening to, I listened to the Fed, the entire Fed meeting with Chair Powell. And when he said that they were at neutral, we were at neutral rate, I was like, you got to be kidding me. And, you know, Larry Summers came out and said, Jay Powell said things that, to be blunt, were analytically indefensible. There is no conceivable way that a 2.5% interest rate in an economy inflating like this is anywhere near neutral. And he is absolutely right. I wrote back, even back in mid-May in my notebook, I remember looking back and I wrote down a comment, and somehow he was talking about neutral rate back then. And I thought to myself, I wrote down, does the Fed have any idea what a neutral rate really is? So we're gonna find out, and it does make me wonder, because to me, it seems like it ought to be pretty simple math. But that's where we're at, and that's where we're at with the 10-year yield. Let's take a look at the dollar index and see how that's looking. Okay, so right now in the dollar index, I'm saying that the primary wave 1 up of cycle wave 3 has completed, and that is with the high that happened the week of July 10th. Okay, I was thinking, when I look at the daily chart, I kept thinking maybe we're going to get another push to the upside in here. But the more I looked at this, the more I thought, this looks pretty strongly like the last little leg is up, and it fits with several other things going on. So right now, I'm expecting this to pull back. That would, to me, be kind of in sync if we continue to get the 10-year yield pulling back. You know, and when you weigh all that going on with the readings that we're getting on the weak economy, and then you got to weigh that against the fact that supposedly the Fed is, you know, well, they are raising interest rates. They have for 2 periods in a row now. Are they going to continue to do that? We'll see. But, you know, this is the best picture I've got, but I also think this is just one more primary wave 2 coming back down. Okay. So we'll see how far it really wants to pull back, see what kind of shape it takes. And I do think that this is driving some other things. Like all of a sudden, it seems like gold is getting some life to it. You know, GLD was up 46 cents on Friday, and it had one heck of a week for the first time in a long time, up $3.43 for the week. But here's what I think is going on with gold. I think gold is working its way down short-term wise, which seems to fit with a pullback in the dollar. Short-term wise, I'm expecting a rally for a B wave as a part of an ABC, a corrective move down. I just think we've got an ending diagonal pattern underway here for a C wave, and I base that mainly on the way things played out over the first, primary wave 1 and primary wave 2. So that is the path that I've got here on gold, and I've actually got a very similar one to that on silver. Keep thinking I'm missing something, but no, in terms of that, something I was going to cover, but I think I've got everything. So here's where we're at with silver. Look at the week that silver just had, up SLV up $1.56. huge move percentage-wise. Matter of fact, on my ETF spreadsheet, it was the biggest mover on the commodities this week. I think it was like 8 or 9% for the week. And so here's what happened Thursday, Friday, Wednesday, Thursday, Friday over here on a daily basis. And then here's the weekly view. Now, again, I think this is just part of the bounce. This isn't quite in sync with what I've got on gold. So we'll see what plays out. It seems like a fairly short wave 3. Something else may be at play in here. It may be that this is just the first wave of a bigger wave 3 coming down. We'll just have to watch and see what happens in here, because if this is an impulse wave structure, this wave 4 should not be overlapping wave 1. Well, we don't have a whole lot of room. It plays better on gold. So a lot of different dynamics, a lot of different things going on, there's no doubt. But right now, it looks to me like interest rates are wanting to pull back and going to continue pulling back for a while. Then that could drive the dollar, but then it could, in reverse, drive some of these commodities higher. Okay, that is the picture for this weekend. I hope you found that helpful. If you did, give it a thumbs up. If you're not a subscriber to the channel, hit that little subscriber button. If you like more of this information on a regular basis, head on over to joehenches.net. Check out the website, check out the membership. Everyone have a great weekend and a great week. We'll talk to you on that next video.